History doesn't repeat itself, but it often rhymes. Or in market terms, this market is acting like someone who just drank 3 energy drinks, checked their crypto portfolio, and decided they're a genius at 2:47 a.m. Because there's a story everyone keeps telling in 2026, a story that sounds safe, comfortable, even intelligent, but it might be the biggest financial lie of the year. Let's rewind. 1970s, the Nifty 50. People said, these companies are so strong you can buy them at any price. IBM, Coca-Cola, Xerox. Didn't matter what you paid, until it did. Then they fell 60 to 80% in the next decade. Fast forward to the dot-com bubble. Same story. This time is different. Spoiler, it wasn't. Now in 2026, we have a new version of the same movie. But the hero is no longer just tech. It's AI, mega-cap dominance, and permanent high productivity. And everyone is whispering the same thing. Don't fight the future. Here's where the story gets uncomfortable, because the numbers are starting to look stretched. The S&P 500 is trading at around 23x forward earnings, but the top 7 companies? Closer to 34 to 38x earnings. And those same 7 stocks now make up about 36% of the entire index. That's not diversification, that's concentration. Meanwhile, household margin debt is at record highs, above $1 trillion. Government interest payments are approaching $1.1 trillion annually. Central banks have bought over 1,000 tons of gold in recent cycles, and liquidity still tightening under the surface despite rate cut hopes. But here's the real twist. The biggest lie of 2026 isn't that markets are going up, it's why people think they're going up. Everyone believes earnings are stable, that AI will instantly lift productivity, that profit margins will stay near all-time highs forever. But historically, margins revert, narratives fade, and liquidity always has a bill attached. So what do we actually have today? We have a market where a handful of companies carry the index, expectations are priced for perfection, and volatility is being sold as normal. It feels like stability, but it's actually tension under compression, like a spring being pushed down harder and harder. And yet, this is not a crash warning. It's not a victory lap either. It's something more uncomfortable. Uncertainty at a high price. If you're waiting for a villain, there isn't one. Not the Fed, not AI, not even valuations alone. The real risk in 2026 is believing the story with too much confidence. Because markets don't punish being early, they punish being all in. So maybe the smartest position right now isn't bullish or bearish, it's balanced, liquid enough to survive surprises, curious enough to question narratives, and disciplined enough to remember. The most expensive words in finance are still, "This time is different."